I'd like to welcome to the stage our moderator for the session, Kevin McCann, who is the Policy Manager for Solar Energy UK. We also have Justin, who just spoke with us. We also have Simon Warren, who is the Senior Underwriter for General Reinsurance, Tom Harries, who is a partner at NARDAC, and Duncan Gordon, who is the Head of Renewable Energy at Gallagher. So let's all give them a hand.
Good afternoon, everybody. Thank you for sticking with us. Conscious we are starting a little bit late, so we'll perhaps try and claim 5 or so minutes back so everyone can get off to lunch at the end of what hopefully will be a very interesting panel. So this afternoon we're going to be talking about insurance. We are, of course, here because there is a very significant and expanding pipeline of storage projects being deployed around the UK and indeed the world. And these, of course, are expensive assets. So what we're going to talk a little bit about today, and hopefully learn from the experience on our panel, is about how the insurance industry can help protect these assets, price the risk effectively, and ensure that they lead a long and fruitful life. So without further ado, given that we've just had introductions, perhaps I will ask Duncan if you'd be willing to just provide a bit of an overview, really, in terms of the insurance industry. What are the key risks that you are insuring against, in your view as an industry? What are the things you're thinking about when it comes to protecting energy storage assets?
Thank you. I think it's probably a good introduction just to give some premise to the renewable energy insurance market, and it changed quite drastically around 2 years ago. Storage often was viewed as a parallel from an insurer's risk point of view to solar. It enjoyed solar premium rating often and appropriate deductible levels. 2 years ago, the insurance market, specifically for renewables, took a bit of a step change. This was brought about by insurers making annual losses year after year, predominantly from wind and solar, natural catastrophe losses, and also the attritional losses, i.e. the lower value but higher frequency claims. And so it had been a few years in the making, and the renewable energy insurers all collectively made a step change where overnight, around January 2020, they became more expensive. So as a general rule of thumb, the base rate shifted almost double. You had a change in deductible levels at that time as well. And unfortunately, as Justin had alluded to with one of his slides, some of the notable cases out there in storage just built this perception that shifted the storage piece around, and the insurance costs went up. So that's a bit of a background. It's in a much more stable place after 2 years of volatility. I think everybody involved, from buyers, owners, investors, lenders, and insurers themselves, are more on a stable keel for the future, so that these insurers can be there long term. Ultimately, we have very few insurers that are writing storage. I think we'll allude later on about some of the focus points that these insurers have. More insurers are willing to write co-location sites, so where they can integrate it into a portfolio of wind and solar, along with batteries. And there are fewer insurers available that write standalone battery. So that's just to set the scene, I suppose, and we might be an appropriate time to sort of pass on to Tom or Simon to sort of talk about some of the risk aspects.
Please, yeah, that'd be great. Simon, if I'm developing a battery storage or other project and I come to you looking for insurance, what are the questions you're going to ask me in terms of assessing whether or not you'll provide that insurance and how you'll price it?
Yeah, I mean, it's sort of, there's various aspects to consider. I mean, there's a sort of traditional fire risk, machinery breakdown. Is it under construction? Is it going into operation? Do we want a policy that sort of dovetails all the way through? What is the technology? It's containerized. How is it spaced? Is it stacked? Who's making the batteries? And then really it's about sort of understanding, is it co-located? Is it a single location? What is the philosophy of the company around risk management? Because what insurers really look at is, people buy insurance as a risk transfer product. You know, the top of the chain is to eliminate the risk or to control it. There are various ways of doing that, but fundamentally, if you're installing a battery storage system using lithium-ion technology, that's what the inherent risk is. Now, there are ways, obviously, of controlling that risk, and then ultimately, as you come down the risk management pyramid, you look at risk transfer, which is traditional insurance. And so that's ultimately where we come in, and obviously as a market, we start looking at you know, what are the values, what the sums insured, where is it located? Is it in a flood-prone area? Is it in the middle of nowhere where there's wildfire exposure? So those are kind of the key areas we look at. But what I would say is, as a technology, you know, ensuring traditional conventional power is very, you know, we've been doing it for years and years, but as we sort of moved on into the renewables, you know, the evolution of wind, offshore, onshore, you know, direct drive turbines, and obviously the ground-based solar, battery storage is kind of this, you know, we see it this new, almost like this new technology, but fundamentally, if you take a step back, you're looking at what is the inherent risk of it, what can go wrong, and what happens if it goes wrong. And as an insurer, what we do is we set our capacity. We sort of say, well, you know, what limit do you need to buy? Do you need a 100 million limit, a billion limit? How much capacity do I want to put out? And what do I think might go wrong? And we look at normal loss events, which might be 1 or 2 containers versus maximum foreseeable loss, which would be your, you know, your export transformer. Very sort of rare event there. So that's kind of the main areas. I mean, I don't know, Tom, if you've got sort of any other areas from a broking perspective.
I can try. I mean, I think of it very simply as insurers are there to pick up unexpected losses, right? So when it comes to battery storage and the history and the track record of some thermal runaway events, the challenge we have is, do they become expected losses and then they get priced into the insurance? And then it becomes a question of, can you get cover, and if you can get cover, at what price? So, you know, deductibles and whatnot, and limits, etc. And so I think that's for me, it comes down to be as simply as that. Does thermal runaway become an expected loss? And if it does, that's expensive, because suddenly you're looking at expecting one container to be wiped out, for example, and hoping there's no spread or cascade to other containers. So I think fundamentally it comes down to that. Insurers are not there to pick up expected losses. So if this becomes prominent and popular and common, then it'll start to get excluded. We've seen that in wind and solar with particular types of losses. Could be microfractures, could be particular problems with some wind turbines. They get excluded from the insurance because they're expected to break. And so it's the same thing with storage, basically. And then it comes down to very simple things. You mentioned all the different factors, but then it comes down to fire detection. And we're seeing a bit more sophistication now from insurers, where on the detection side, they want to see active and passive detection. They want to see what's happening with monitoring the battery health, for example, both software sides, but then also hardware products, potentially like yourselves, Justin. People want to see these sort of things now because they're not comfortable with the sort of as it stands, as it has happened. They want to see how we've learned the lessons from previous thermal runaway events. And a lot of the time it's difficult because there's a technology angle to some of this, but there's also a human angle to some of this where we've seen human errors. And I understand there's a learning curve, and everyone understands that, and I think insurers are pretty open to that they're keen to help finance the transition. They don't want to be a blocker in any of this, but at the same time, this needs to make commercial sense.
That's really interesting, thank you. Tom, if I may just pick up on a point, I know you've got a background in research, and we've mentioned already a couple of times that the industry is relatively new, and Justin, in his presentation a moment ago, picked up on a couple of sort of well-known examples of fires, but what is the insurance industry, what's the sort of the data set almost? What's the basis on which premiums are currently being priced? And do you think that as the quantity and quality of information increases that's available on you know, typical loss events as you describe, will that have an impact on pricing going forward?
Yeah, for sure. I'll kickstart this, and Simon, I'm sure you've got plenty of thoughts, Simon. But yeah, I mean, there's no track record, or not much of a track record. It's been brought up in various conversations over the last 2 days. It could be on revenue profiles or revenue streams. It can also be on performance, battery health monitoring, everything. And so, yeah, you're right. Without a track record, you have to price in uncertainty. And so when you look at insurance costs, for example, when you're seeking out quotes from different insurers, there's a huge spread in the kind of prices you can get. And more often than not, that reflects the uncertainty that some insurers feel towards this sector, because there's no track record, or they have a bad history with it, for example. They've paid out a particularly big claim. And so I would say you see a bigger range of quotes for sure in battery storage than any other renewable technology. I mean, you're talking 2 or 3x from the lowest quote to the highest quote from different insurers. You wouldn't see that in solar or wind, onshore or offshore. And that's just purely pricing and uncertainty. Simon?
Yeah, I mean, that's a great point, you know, around loss history. I mean, that's, you know, what a lot of insurers do. I mean, we're sort of stacked with actuaries who are sort of analyzing loss data going back, you know, 50, 100 years. And, you know, I think just as a broad brush across the whole sector, when you've got loss history, you can start thinking about how you price. But when you don't have that, and to sort of Duncan's point earlier on, when the market was soft, people were sort of saying, oh, it's kind of akin to a solar risk, so we'll apply a solar rate. And then suddenly losses are happening and insurers are saying, well, actually, this isn't quite right. So what do you do next? You start looking at, you know, return periods. You know, what do I think? How often do I think I'm going to suffer a £1 million or a £5 million loss on this this portfolio? They start looking, you know, it's quite a rudimentary way of doing it, but when you're not armed with that loss history, it's really difficult to do. And I think just to sort of talk around the, you know, the market in general, you know, going back to Duncan's point, you know, a couple of years ago the market was very soft, and then what certainly I've seen, I used to do a lot of work in commercial property in the food industry, where everyone sort of piles in, the rates are driven down, and then you kind of, people take the eye off the ball, they're not risk managing, they're not, you know, doing the maintenance they need to do. Then you start having losses, and then suddenly a carrier who was thinking, you know, I'll put 10 million capacity on this risk, loses a lot of money, and then says, well, I don't want to write battery storage, or I don't want to write food anymore. And then the market starts to sort of creep up. Then people start sort of piling in again and think, well, I can make money again. And it's sort of a cyclical nature. And it's really, people sort of say, well, if I do X, Y, and Z, how much does my premium go down? And the answer is not, it will go down. It might be, well, if the market goes up 10%, are you the best? Are you in the middle, or are you the worst? Are you going to? Could your rates maybe go up 50%, or could they only go up 5%? So it's quite a difficult question to answer in terms of sort of riding out the market.
Of course, thank you. So to turn that question on its head, and I'll come to Duncan first, if that's okay, and then I'd like to bring Justin in. We're in a room full of storage professionals. You're insurance professionals. For people developing storage projects who are seeking insurance, what would you say to the room that they need to be doing in terms of their research on the insurance industry, as opposed to your research on the storage industry, to understand how to secure an insurance product that will basically safeguard their asset, but at a competitive rate, in light of what you've just been saying about the fact that there are broader cyclical dynamics affecting insurance that may not necessarily be project or technology risk specific? So perhaps, Duncan, if you could comment on that.
Thank you. Yeah, absolutely. So I think, you know, any of the brokers that specialize in renewables and specifically storage will advise you to engage them as early as possible. And one of the benefits in doing that is that they can introduce you to all of the sort of dynamic concepts that insurers are now akin to. So 2 years ago, insurers were not naive, but perhaps they hadn't deployed as much engineering in-house capability towards storage. They now have, because they want to support the green sector. The growth of that is attractive to some insurers. And so now they effectively have guidelines, NFPA, 855, of course, and looking at other products, you know, such as line tamer, looking at ways to minimize thermal runaway, looking at ways to mitigate risks such as separation between units. I think historically property insurers look for 20 meters, but what site has 20 meters, be it solar or battery? And I think the acceptable position is around a sort of 2 to 3 meter mark. Now that might have been a step change from the 1 meter spacing that was planned. And if you hadn't engaged an insurance broker at an early stage, what you could be finding is when you come to go to the insurers for quotes, you might find that it's not so much cost that's the issue, but insurability. simply down to separation of site. Now, obviously, every site has to be commercially viable, but this can only be factored in at an early stage. Just coming on to sort of the EPC selection and the drafting of EPC contracts and O&Ms, and if you engage lenders and debt finance, you know, as we've been alluding to, the insurance market evolves all the time. One of the biggest swings on that is the deductible level. Historically, in the UK, the deductible levels used to be around 50,000 sterling as a delivered, commercially available, and expected deductible level. In these last 2 years, it's now found itself up to the mark of 150,000 to 250,000 sterling. And I'll just sort of touch on, you know, we're talking specifically UK there, but we are all active globally, and I think it's remiss to not acknowledge that every different country has its own sort of insurance carrier focus. So again, with the cycles of the insurance market, you also have volatility created by the competitive landscape globally. So Germany, for example, has a very sophisticated insurance market where the majority of assets are covered by the German market very competitively. If you're looking at broader, again, Asia, with Singapore has a very competitive market. And I suppose the reason I'm mentioning that in the context of the question is that engaging the right insurance brokers early on, they can ensure that every viable insurer is engaged with a specific project or a specific asset, that those insurers are clued in, that they are able to inform the project as to what they would expect in terms of risk mitigation, so that when it comes 6 months, 12 months down the line, where you come to secure your insurances, you have buy-in from the insurers. So they're more willing to already be leveraged. The broker can bend their arm. The broker can bring in leverage from other portfolios that they might work on. And overall, that looks to bring the costs down. But I think it gets past that first hurdle that we've all been talking about, which is insurability, which I think was a slightly scary time 2 years ago in the sector.
Thanks so much. I'll just come to Justin and then to you, if that's okay, Tom. And so you've started to move a discussion on then, of course, to the second part of the question, which is, well, if we've got these risks X, Y, Z, how, of course, do we mitigate them? You mentioned the importance of engaging your insurers from the beginning. Justin, I wonder if you could perhaps comment a little bit on at project design stage, what the other aspects of project design are that will help ensure that insurability. Duncan mentioned, for example, spacing, relating either to thermal runaway or other risks that you're aware of.
Yeah, I mean, there's a whole heap of documents these days that help in this regard, and it's not just our own, but looking at, you know, they do help drive this, the Americans with the NFPA 855, you know, sorry, I'm repeating myself, our own guidelines. The more information people are able to share with not just the likes of ourselves, but get the insurers involved earlier, the better. It was something you said on a panel yesterday with my friend Ian over there. You know, get everybody involved early. There's no harm in doing that, even if then for whatever reason you decide to go down another path. Start the conversations early. We are only trying to help. These technologies, as I say, they exist now. They're available, but not necessarily mandated or regulated, but they will be, I guarantee you, in the future. You know, be early adopters, take the right, sensible approach.
Thank you. Tom?
Yeah, I think there's a few basic lessons here. I think one is insurance is as important as borrowing for most people needing the project finance, for example. It shouldn't be an afterthought, and it's easy for us to sit here as part of the insurance industry and say we're important, but we really are in this case, because the question here is not just lowering the cost, it's insurability in the first place. So can you actually get insurance? If the answer is no, good luck borrowing money, is the simple story. But also then, let's say the conversation's begun. This could be a client of ours, in some case a developer. What's very important, we've noticed, is their relationships with their suppliers and their EPC contractors, because insurers, people like Simon, for example, will have a list of questions they need answered. And our job is to help answer those questions. If the communication channels are open, then that project becomes a lot more insurable if insurers feel like they're being listened to, their questions are being answered, they're being answered appropriately and fully. I mean, this is basic stuff, right? I mean, this could be a question along the lines of, great, you've got this integrated solution for a battery. Can you give us more information on what exactly are the sensors in the container? And at the moment, some of those questions just don't get answered because suppliers are, it's a great time to be a supplier, right? Everyone wants a battery, it's hard to get hold of one. They claim they haven't got the time to answer the questions, but from a buyer perspective, that's jeopardizing your insurance. So there's an element of what leverage you have over suppliers and contractors, but these are just answering simple questions. And then what happens is if you can get those questions answered, you improve the insurability, potentially lower the cost, but also ensure insurability.
Yeah, I mean, just to add on that, so obviously I underwrite, I price, I sort of find solutions for clients, and sort of in my I guess my former life prior to underwriting, I was a risk engineer, so I spent sort of 15 years of my life sort of traveling all over the world, inspecting factories, and went to, climbing up wind turbines in Turkey, and, sort of lots of weird and wonderful things. And, I had that benefit of seeing it, feeling it, and breathing it, but there's a lot of people in the market that haven't had that. Plus, we've had 2 years of COVID, and it's not allowed risk engineers to get out to sites to see their clients. There's been lots of virtual surveys, and it's also not allowed underwriters to get out to site. And what we're sort of seeing in the London market is there's been a step change over the last 5 years where, we're very top heavy, lots of old heads in the market, sort of in their 50s, and people are kind of, moving into retirement, and we're getting a lot of young people through coming into underwriting, and they don't necessarily have I'm a chartered mechanical engineer, and there's not many people with my background, lots of very, very bright people, very good with numbers, but they don't necessarily, they can't sort of feel it and breathe it. And I think the one thing I would say is what you need to really be thinking about and working with your brokers is getting insurers to site, because there is nothing better than having a panel of underwriters who may, you might be looking to buy a £250 million limit. One insurer is not going to provide that capacity. You might have 5, 10 insurers. And I think if you can get people to your sites, get them looking around, talking to the engineers, looking at the containers, seeing the technology, seeing the separation, seeing how it's managed, it's going to make a world of difference, because for each project you have, when you move on to the next project, that underwriter's thinking, oh, well, I've seen this, I understand it. And also, just really quickly, the way a lot of companies will underwrite is it's called capacity. It's how much capacity can I put down on any one risk? And you may be able to put down £50 million of capacity, but a lot of companies work in a way, it's based on the information. So if you've got a company risk engineering survey, you can put down 50 million. If you don't have a survey, you might only be able to put down 10 million. So I guess the thing is getting people to site, getting them to understand it. And people call it unlocking capacity. And I think it's really, really sort of critical, sort of certainly where we are in the market right now.
That's a really helpful piece of practical advice, I think. I'll ask perhaps one more question, and then we'll see if there's any questions from the floor, and if not, we can carry on. What I'm hearing, I think, is that there is potentially, but please correct me if I'm wrong, a risk of different perceptions among existing professionals, new people coming into the industry, and perhaps a lack of understanding of the respective industries not talking to each other. So I suppose to follow on from your previous comments, Simon, if anyone on the panel is interested in responding, what would you say the storage industry could do to try and promote understanding of the technologies and the projects in development to support squaring those perceptions of risk, generating the sort of data and loss profiles and so on? That would be required to help bring costs down, noting, as you said, that one very practical step is getting people out to site. Tom, Duncan, or Justin, anyone to begin with?
You go, Duncan, your turn.
Well, and excuse me, Simon, but I think the difficult people in this context are the insurers. And so anything that can improve their perception, which I feel in this context, the panel here, they're most, we want them to secure capacity for your project or asset. We want it to be cost effective long term. So one of the takeaways from I suppose some of the larger wind projects that are now using turbines in excess of 5 megawatts, with that's brought many challenges, some of the newer technologies, which everybody's working through. And I think where value is added to those projects as they go to the insurance market is through independent risk engineering reports. Now, it used to be the case that you would just rely on an in-house project engineer's report or even the lender's technical advisor, for example, and their insight. But I think where you have the exposure of fire, and we've seen this in the waste to energy space and biomass, specifically independent fire risk assessment is one aspect, and independent risk engineering reports as well. Now, with these two aspects in mind, you instantly, as Simon was alluding to, and Tom, you improve your perception to the insurers. And so doing that early and sort of bringing in that cost base into your development cost early on and knowing that will bring value, that's how you sort of boost your perception, I would say. I would say the industry as a whole, and it's terrible. All it takes is one public news article, and the perception of Joe Public, can be that it's much worse than it is. And I think each individual insurer is also guilty of buying into that news public perception. And it's only when they are, let's say, getting the data and looking at each risk and seeing that they are performing generally well and can be profitable for these insurers that long term it will stabilize.
Yeah, just to add to that, I mean, back to the sort of debt analogy and borrowing money. If you wanted to raise debt, or borrow money, I should say, then you do all you can to prove how secure your future revenues might be so you can borrow against it. And you spend a long time and all sorts of forecasts, all sorts of data, anything to back it up. But on the insurance side, it should be very similar. So insurers are there to cover potential losses. So it'd be good to see maybe more attention paid to how is fire potentially being mitigated, how is thermal runaway being mitigated against. It's very rarely on marketing materials for kind of obvious reasons, but then it also maybe should be there. When you speak to different suppliers, new suppliers, existing suppliers, it's often second or tertiary when they start talking to you about, okay, what sensors do you have? What do you not have? What have you thought about? What could be an add-on that you could put on? It could be an external sensor provider, for example, which might mitigate the effects. And then you can start to have a conversation. So I really think in a market where there has been a lot of well-known and well-publicized incidents, people should be tackling those head-on initially to satisfy people's concerns. I mean, back to what you were saying, Duncan, people need to recognize that underwriters in this market, they underwrite stuff globally. So if there's an incident in a battery project down under from a major manufacturer, for example, hypothetical, those underwriters are probably on that project. They're potentially at loss. They've been given an estimate of the loss for that project. And we're going to them and saying, hey, do you want to underwrite this new project in the UK? And they're saying, hang on a sec. I'm just trying to understand if I've lost 5 million, 10 million, 20 million, who knows? I need to know the lessons learned off the back of that loss on this project, despite them being the opposite sides of the world. So people talk, a lot of these battery fires are well publicized because they make good pictures in news reports. And so I think people need to recognize the industry on the insurance side is very sophisticated and people are very aware about what's going on. So I think tackling these questions head on will certainly help.
Thanks very much. Yeah, I think the point is noted and agreed with. Safety is, of course, the first priority of the renewable energy industry, but we do want to make sure that's in line with the sort of objective level of risk. I think we've got about 5-10 minutes left. So at this point, are there any questions? Perhaps the gentleman right at the back in the dark jumper.
Can we have hands up again?
Yeah, I guess Paul Markham from PM Risk Consultants. From an insurance perspective, where is the point at which we talk about getting engineers to sites to do surveys for the underwriter? Where is the point in terms of megawatts or megawatt hours that doesn't become cost effective? Have you considered that?
That's not something I've personally considered. I think from a direct insurer perspective, I mean, what you're really looking at is, the amount of capacity you're putting out and what you're willing to retain. And without going into huge amounts of detail, insurers tend to have treaty reinsurance sat behind them, so they're going to retain a certain amount of risk net. So I think for me, it's really about getting the information in the first place. I think you do need to get engineers to site, because I think where we are as an industry, I do feel that there's just this lack of knowledge, and I feel that there's sort of the confirmation bias that you see incidents on the news, and what you don't want is those underwriters to sort of say, "Oh, we don't want to write those sorts of risks." So I think it's something. Looking at the chart, certainly that Justin put up, with the way we see the growth in industry, I think it's something really important right now that we need to get people onto site, and we need to start educating the insurers, and also to have that two-way dialogue with, obviously, the insureds, the lenders, etc.
Yeah, I fully concur, and I was trying to allude to the fact that the problem with storage is if you are the premiums that you get for engineers to pay for that becomes a fairly high expense ratio. So with technology, surely we should be getting better at pulling the information. And you're quite right that the industry has suffered for many years from very, very poor information. Therefore, shouldn't we be using AI and or data and get it formalized so that we can see and the owners, the users, know exactly what it is we are looking for?
Yeah, I mean, absolutely. I mean, if risk engineering, getting boots on the ground is very expensive. I mean, to put me on a plane and fly me to Turkey to go out to a wind farm in the middle of nowhere costs a lot of money. But I think when you're sort of looking at portfolio level, you do need to get the boots on the ground in the first instance to kind of get a feel of the risk and the philosophy of the company. But I concur in terms of the technology you can use to to do remote surveys, to look at sites through satellite imagery, to look at spatial separations. There's a lot of that information that you can use, and certainly we do use when we're looking at portfolios.
Thank you very much. Questions, please? Yes, in the blue shirt. Oh. Okay, here and then over here afterwards.
Sorry for jumping in by the looks of it. Matt Elliott from IEP Technologies. There's been a lot of talk around prevention when coming to sort of fire and thermal runaway. But in our industry, one of the things that we're seeing is the biggest loss is when thermal runaway occurs and you get an explosion. We have methods that we can actually employ to use and reduce that risk if there is an explosion. Is that things that insurance companies will be looking at as well? So some of the battery storage or the BESS systems here have explosion protection and some do not. Is that something that the insurance industry would look at and say, okay, it's a driver for lowering premiums?
Yeah, absolutely. I mean, don't forget, when you've got an energy storage risk, it's not just about the physical asset. That physical asset costs £100,000, but it's the business interruption that's you insure as well. So when you look at losing a container, you say, well, I lose a container, I know it costs X, but actually what is the impact on the business? There's going to be loss of revenue. Now, if I can't just call up tomorrow and order a new container and it turns up next week, there's going to be loss of revenue. I mean, what we need to determine is, where can the losses happen? What can go wrong? How can we prevent them? Prevent physical loss, property damage, and also prevent business interruption. I mean, don't forget, there are going to be certain aspects of a project where you're going to have critical junctures where if I lose this piece of equipment here, actually it could take out multiple units, or it could take the whole site out. Now, the cost of that equipment may be extremely low, but the business interruption potential is very high. I mean, a few years ago when the Olympics were on, you couldn't get transformers. And we had clients that were terrified that, well, if I lose this 2,000 kVA transformer, I'm not going to get one. And that's going to have a major impact on our business.
Yeah, I think it's also prevalent now with the difficulty in securing batteries first and foremost, not just in constructing projects that they arrive on time and as promised, but also, as you mentioned, Simon, in the event of a replacement being required, what is that lead time? Because that lead time is probably a lot different to what it was 2 years ago, based on either logistical macro constraints or just an industry where there's a shortage of supply, for example, given the increase in demand. So those are moving targets, but insurers are certainly very aware of that.
Thanks very much. Could we please have a microphone to the gentleman on the right here? Thank you.
Thank you. Neil Bradshaw, Sungro. What is the insurance industry doing to look at different suppliers of hardware risk in terms of fire and explosion based on history, but also based on what they have? So nothing against adding sensors and things like that, but I do feel like there are some suppliers that are more prone to fire risk just because of the way the equipment's designed, how the cells are connected together and things like this.
That's a really good question and very topical. I think, you know, from my personal experience, the conversations that we've been having with insurers over the last few years, they've remained technology agnostic. So they may have, yes, some cases where a specific technology supplier has incurred claims. However, they're not at the point yet of sort of putting out sense checking whereby they would, you know, advise against a specific supplier. And from what you're alluding to there, you know, you made an assessment that there's perhaps some that do pose a greater fire risk. Now, insurers are more reactionary in that sense. So they look at their own data or the publicly available data. And I think, you know, this also feeds into the previous question as well, in a sense that confidentiality is an issue. So post-loss, post-claim, you know, and the same applies to any sector. The contractor parties involved, the suppliers involved, you know, once the bones of it has been worked through, nobody really wants that in the public sphere. So it's very rare that we all publicly see the lessons learned, that people can move on from that. And the same applies to technology suppliers as well.
Yeah, I think I wasn't meaning, you know, lessons learned, but say, for instance, if I have a car accident, my insurance premiums go up, right? I'm a bad driver. Or if a certain type of car is continually having problems, you know, that might drive up insurance. So what about sharing that data? Does that make sense?
No, I was made the point that technology changes so quickly. So I see your point, but comparing like for like in the battery storage industry over a period of more than 12 months is very difficult. So you compare the risks we were seeing 2 years ago, some were stacking assets, they containerize, their NMC, blah, blah, blah. Today, you're seeing LFP, cabinet solutions, they're not stacked. They might have additional third-party material in there, such as sensors for off-gases. We're seeing more on the software side for monitoring the state of the health of the batteries. So when you put all that into a package, it suddenly looks, well, when things are being monitored more often, and it looks very different to the one 2 years ago. So I see your point. I mean, I raised a question earlier on the debt panel. I was trying to work out if there's, you know, on the lender side, do they have a sort of blacklist of suppliers? And the answer is no yet. I think partly because it's changed so quickly, and partly because the way these solutions come as an integrated package, you know, ultimately, where do you draw the line? Because you might have various integrators, but they're all using the same cell manufacturers. So in answer to your question, I think that we will get to a point at some point where, a bit like in the solar industry, there's a proliferation of suppliers back in the heyday, and then suddenly you saw that reduce as you saw poor quality or whatever it might be. Companies dropped out of the market, and then there was a bit of, less suppliers, I suppose.
Thank you. Conscious of time, I know we've got a question here, and then perhaps one more at the back. I think there might have been a follow-up, and then we'll probably wrap up after that. So please.
Thank you. Randy Stacy, Lion Tamer. So you've got this market that's experienced, it's an emerging market with supported by emerging technologies, and it's got this hockey stick growth curve. There's no chance that regulations are going to catch up anytime soon. So what role do you think insurers can have in shaping market conduct as we go forward? Is it going to be reactionary, or are you going to try to be proactive? You know, left to their own devices, it's a Wild West out there when it comes to the back end of an energy storage system, and that's why there's so many, as evidenced by the catastrophic fires, that's why there's so many systems that have suppression on the back end or detection that isn't capable of taking care of a fire if it would break out, or preventing a fire from breaking out. So at what point and what role do you think insurers should play as this new market forms?
Yeah, I mean, obviously we want to be proactive. I mean, if I think of other if I think of pure fire protection technology like sprinklers, very, very mature, been around sort of over 100 years. Technologies change, but there's a very nice sort of forum that's, you know, designers, installers, insurers, brokers, and they sort of they meet and they discuss these changes. Whereas, you know, to your analogy there, it's like a hockey stick. You know, technology is changing so rapidly. I think ultimately it's, you know, yes, we've got to try and be proactive, but I think there is going to be, you know, a large degree of reactivity there. But I really think it's just about the education, the involvement, being open and transparent and discussing. And I think really that's all we can do for now. There are certain, you know, in the US, there's the Property Insurers Research Group. In the UK, there's the Risk Authority. There are various sort of bodies in place where the insurers sort of meet and they discuss topics. Certainly on the power side, there are various forums in place that, you know, insurers meet and they discuss trends. And I think we've just got to try and do our best. But I think with this technology and this growth potential, it's gonna be, unfortunately, it's gonna be very, very difficult.
Thank you, Simon. Right, we're definitely on time, so please, one brief, if you will, follow-up comment.
Tom, if I just may come back to the question that was asked by the chap from Sungrow, and having worked in the power industry now for, power insurance industry for 18 years across the whole of the power market. And I'll give you an example outside of batteries, but if I was to talk about gas turbines, there is information that comes available from gas turbine OEMs about problems, service bulletins. And so I know, and I advise other insurers on the batteries, and I think I know what is being referred to here. There is a particular battery manufacturer who I would be very careful with. Going forward, there may be changes. I agree with that. But if there is existing assets that are coming into the market and somebody asks me my opinion, I would be saying be very careful with one particular. So the insurance industry should be reacting to those sort of things. Whether they insure it, take a smaller proportion or a bigger proportion, is up to them. But there is an awareness amongst risk engineers in the power sector of some of these issues.
You're absolutely right. And what I always like about the insurance industry is they see everyone's dirty laundry. There are very few other people in the value chain that see everyone's laundry, because whether you're debt finance or equity finance, nearly everyone buys insurance. So we have to see everyone's projects, data, design, call it what you like. So for 100%, the insurers are aware, we're aware of who, dodgy is the wrong word, but suppliers maybe with a checkered track record. Of course we know, and that's the point Duncan raised, which is if you speak to us early as project developers, we can inform you of that. It could be a simple question of, are there any suppliers that we should watch out for? And more often than not, that supplier is probably the cheapest in the procurement process. And we can say, look, they might be the cheapest, but you might be jeopardizing your insurability or whatever it might be. But it's similar for other aspects. It could be spacing, for example, on a project. And just coming to us and getting a rough indication of what's a reasonable spacing to have, which might help people like Simon insure your project. So I think it's early engagement, but without a shadow of a doubt, I wouldn't underestimate the data insurers have. Like I said, not just on projects, they're global, and similar to yourself, they're very experienced across the entire power system. So they've seen it all before.
Thank you very much indeed. On that note, I think we should probably wrap up. So I'd just like to say thank you to the panel for sharing your expertise. Please do come and find any of us this afternoon and enjoy your lunch. Thank you.